Hey, everybody. This is the live stream, Financial Thing live stream. Welcome. It is Friday. I don't know what the date is, March 27th. And just give me a yes in the chat if you can hear me. Sometimes these things do technically not work very well. So if you can hear me, just somebody give me a yes. That would be much appreciated. I'm going to chat today about what's going on in the peer-to-peer lending world and the financial world and what's going on with the coronavirus. Things are a bit crazy, unprecedented. Thank you, David and Peter. Appreciate it. Definitely unprecedented times that we're seeing now with what's going on in the world. And we chatted last week about sort of the peer-to-peer lending landscape and what's going on in the stock market. So we're just going to sort of do a recap and answer any questions that you have, any concerns. I know a lot of people within peer-to-peer investing and also the stock market are very concerned. I'm getting a ton of emails every week. People really looking for direction on what to do with their investments. I've always said that this is hopefully going to be a short-term crisis and everything should return to normal. That being said, there are some things that you are going to definitely want to keep an eye out for. But a couple of different things too. I'm a bit of a natural health person. So, obviously the world has their eyes on this coronavirus. So I want to give you a couple of things that I've sort of stumbled upon on the web that you might find useful during this situation. One of them, I'm going to put a link in the chat here for this really great website that I found called Waldometers, and it gives you a daily update of how many supposed cases there are of the virus in each different countries in the world and some statistics on that. It's really actually a very useful website too for other things. It talks about national debt, a lot of the financial barometers to do with national debt in the US and also births and death rates in the world. It's pretty fascinating. So put together by statisticians who are a lot smarter than I am. Did I put a link to my, oh well. Yeah, sometimes people make mistakes, me included. So anyway, that is one link. Another one that I thought was really funny was how much toilet paper estimator. For everybody who's worried about their toilet paper supplies, it's just a bit of lighthearted fun. It will give you an estimate of when you will run out of toilet paper, if ever. So it's a couple of links for you. Hand sanitizer and bacterial soap is very hard to find, but it is essentially very easy to make yourself. So I started looking into this when I realized that I didn't have much hand sanitizer left. And you can make it very easily by buying grain alcohol. And if you happen to have some essential oils, tea tree oil is a great antibacterial. If you happen to have aloe vera gel, which is very hard to find right now, you can use that. But if not, just grain alcohol, tea tree oil, and water will make your own antibacterial hand sanitizer. I'll put that in there. And also, if you want to make your own soap, Castile oil, water, and again, tea tree oil, which is an antibacterial. So you can make your own stuff right there and not have to worry about buying it from the shops. So let's talk about, I put up an article on Financial Thing a couple of days ago talking about, how to handle your investments during this crisis, how to handle your peer-to-peer and your stock market investments, what my personal opinions are on the economic outlook of what we can expect going forward. What I found really interesting, especially in the US, we're having this balance between the president, Mr. Trump, trying to balance between economic meltdown and the health of what's going on in the country. And I think it's happening in the UK too. Obviously, the shutdown for 3 weeks is massively impactful on the economy, but you have to wonder, how long can countries really afford to be shut down for? before the economy just sort of melts down. And that's one thing that's going to be very interesting. You're seeing a lot of these economic stimuluses being put into place now. One that I found was really interesting in the US, the Federal Reserve, or the US Fed, is actually purchasing corporate bond ETFs to provide liquidity in the marketplace. That's one thing you're seeing within peer-to-peer lending right now, is that if you want to exit, there is practically no liquidity through many of the platforms. So what the US Fed has done in the US is they're purchasing these ETFs to provide liquidity for people that need to access money, so they can sell their corporate bond ETFs and get access to the money. So you're seeing these really interesting economic stimulus pushes that is putting a lot of money into the economy. And when this passes through, you're going to have a lot of economic stimulus that is continuing to be inside the economy. And I think you'll see a takeoff in the economy. Who knows how long it's going to take? It just depends on how long it takes for the virus to sort of run its course. Hopefully that'll be soon. Obviously, the travel industry is just having some severe problems. I don't see that changing anytime soon. I mean, I don't think I'd be too quick to want to hop on an airplane, even, if they give you the all clear. How long is it going to take before you're actually going to really feel comfortable hopping on a plane? But there is a lot of stimulus. Virus, I think is going to be a short-term effect, but you're probably looking about 3 to 6 months economic effects short-term. People like the airlines are really going to struggle for much longer than that. To give you an example, Delta Airlines is losing about $50 million a day and having to tap into billion-dollar credit lines to keep on running. So you will see some economic outplays that are longer on the travel industry, which obviously makes up a big economic part of the world, so that might have a knock-on effect. One of the things I really wonder about is how businesses are actually going to repay debt. Even if a lot of small to medium enterprise businesses are going to be offered lending, financial banks and the government putting in loans, but how are they going to repay that debt is a really good question. If they will be able to repay it, and is that going to cause some of these businesses to actually fold because of the too much debts on their shoulders? Now, the bigger corporations may not have an issue with that, as they'll be able to increase their cash flow as the economy sort of returns to zero. But small and medium-sized businesses, it's going to be interesting to see. Very sad, obviously, if that happens. What I wanted to do too is remind you that there is risk in every type of investment. I know we're predominantly peer-to-peer lending discussions here, but if you're thinking about where can you put your money that's a safe haven, you have to really look at risk. Right now, a lot of people are going to bank savings. The problem with that is if you do that too long, you're just losing money to inflation. I think you're lucky if you're getting about 1.3% interest in the UK. And the banks at the moment, over a long time, you're just going to lose money to inflation. Your money is going to become less valuable as costs of goods and services go up. So there's risk that is involved in that. Also, believe it or not, cash in a bank is not exactly 100% safe. Because look what happened in some of these countries that economically collapsed in the previous decades. There was a run on the money in the banks, and the banks couldn't pay out at the beginning. The government would have to step up to ensure those bank withdrawals, but it's not 100% safe. Also, stocks, you've got that downside of the capital losses that you're seeing now within the stock market. Anybody that's checked their trading accounts will see your usual types of equity investments right now are down 20 to 30%. So you got the risk involved in that. If you buy bonds, especially bond funds, they can lose money during economic downturns. And one of my favorite bond accounts is the Vanguard in the UK, the Vanguard Global Bond Account, and that's actually lost a little bit of money during this stock market downturn. I think about 2.5–3%, which is a godsend compared to the equity accounts, which would be down 20 to 30%. You've got the risk of corporate bonds too. Some people are really big into these corporate bond accounts, which I've never really been a fan of. I thought that the interest rates they pay out are not really level with the risk that you take. And if you own a corporate bond account right now, fund, you may start to see if, God forbid, some of these companies do go out of business, maybe the travel companies or ones that are high risk. Those bond funds can be particularly volatile, so you have to be careful with those. And then you got peer-to-peer lending, which obviously has its own risks. You got the loan risks through the borrowers not being able to repay during these economic downturns. And you have the risk towards the companies, which we've seen in the past with Lendy. We've seen it with Funding Secure and a couple of other collateral, and some of the European companies that are mainly Estonia based that are really struggling right now. So you got risks in every facet of investment. You have to remember that there is really no safe haven. So, I think my point there is people are generally worried about peer-to-peer, but there is risks in every type of investment, and peer-to-peer is no different. So let's take a look at what is the future of peer-to-peer lending right now. And actually, I think the sector myself is going to be okay. What you're going to see happen is companies are going to need finance, continued financing, maybe more than ever now. And the peer-to-peer lending companies can provide that in many ways that the banks can't. What you're seeing now is a lot of the banks are freezing lending. They're not going to lend to the small businesses. They're not going to lend to probably the medium-sized businesses. And this is why I think peer-to-peer lending is such a great tool for these companies, because it solves two problems. It solves on the investor side, like me and you guys, that you're looking for a return on your money that's better on the banks. So you have that solution to that problem. And then for businesses that need financing, they can go to peer-to-peer lending companies, and the peer-to-peer lending companies are just a lot quicker than the banks. So when it comes to financing, if most small businesses can't get bank financing anyway, so peer-to-peer is going to continue to fill that need. What are you going to see? There's going to be an influx of peer-to-peer lending applications on loans. And what's going to be really interesting is watching the companies that are doing the loans to see how tight they keep their lending criteria. I think you're going to see companies like Funding Circle have to really tighten down on their lending criteria, because they're going to experience a lot of loan defaults in the next 3 months, I would imagine. So what's that's going to do is make them really tighten up on their lending criteria moving forward, which is good for you if you're invested in Funding Circle. Personally, not a big fan at the moment of Funding Circle. I exited out quite a while ago. You can read the review on my website as to why. But you will see Funding Circle tighten up their lending criteria in that respect. I'm just going to answer a quick question here. David says, any thoughts about Grove Street's current liquidity event? It doesn't look good to me. Yeah, you're going to see that, David, with a lot of peer-to-peer lending companies, because here's the thing. In order to exit an investment, you have to have somebody that's willing to buy your investment. And probably like you are not buying much at the moment, whether it's stock market or peer-to-peer lending. Many of the other people that are in peer-to-peer now are not looking to buy anything either. And so you have this dry up of liquidity. And that's why you're seeing Grove Street do that. Now, I don't have any information on the inside. I've been a little bit cautious of Grove Street for a while. I mean, the last couple of months, I've seen some signs that are not particularly great with them, but I don't have any information or any reason to believe that they're in financial trouble. A lot of these liquidity freezes are just because there's no way to offer people exit. So they're just trying to stop all of the requests for exit when people are not going to be able to exit. That puts a lot of strain on the resources of the peer-to-peer lending companies if they're getting hundreds of people trying to exit, and they have to process those exit requests still. But if there's no way for the lenders to exit, there's really no point in offering an exit right now. We'll talk a little bit more about that in a minute. So what I did personally was I put in a little test exit for Rate Setter about 7 or 8 days ago. I had some money in the Access account, and 7 days later, I have not seen that executed, and I think I'm not surprised about that. Again, Rate Setter is another company that's probably seeing a lot of exit requests, and they just don't have the demand from people wanting to buy those loans. So there is very little liquidity. You've seen today, there was an announcement from Groupier saying they have delays. That's a European peer-to-peer lender. Monethera, which is Estonia, is experiencing a lot of delays and likely a freeze. They wrote that that is due to them avoiding administration, so some issues there. You've got Octopus Choice, which has stopped both the investment and the withdrawals. Assets Capital also freezing the withdrawals on the QAA. I'm not surprised at all about that. And then Just Us has suspended its secondary market. Again, I really don't have a lot of insight into whether that's a financial issue on their end or if it's just to probably stop the resources that it takes when people are just trying to exit and there is no way to exit. One company that I did have a successful exit transaction this week, and it was very quick, was LoanPad. I did a test exit, and I was able to exit within, I don't know how many hours it was, but it was within 24 hours. So again, LoanPad is one of the companies that I'm absolutely comfortable with at the moment. I think that I don't see any potential issues with them right now. Time will tell moving forward, but as of today, I don't see any potential issues, nor do I in the next few weeks. Remember, exiting is all based on demand and supply, so if you can't get out, it's just like the stock market. If there's no one to buy your stocks, you just can't sell them. There's just no loan buyers at the moment. I don't think I'm getting a lot of questions about what to do with the peer-to-peer investments. One of the things is sort of really okay to sit on the sidelines now. If you're talking about new investments, I don't plan on doing anything new in the short term, but I also think it's okay to stay invested. You know, a lot of these companies are very well funded, venture capital funded, some of the bigger ones. So they have the finances to ride out the storm. As long as the virus doesn't hang around for a long, long, long time, I'd be more concerned. But I think, you know, it's okay to also sit on the sidelines and not to put any potential risk forward, put any risk on your shoulders if you don't feel comfortable. I mean, why take extra risk if you don't need to? But I still am mainly, I would say 95% of my peer-to-peer investments remain as is, and the money is still invested, so I'm not concerned. Did you visit Propland on your recent company visit? UK Soul is asking. Yes, I did visit Propland, actually, and I was quite impressed by their small operation. I actually don't mind companies that have small operations because it means they have small payrolls and they don't have a lot of expenses, which a lot of companies are going to be happy about that right now. But Propland, I thought, had a very sensible take on peer-to-peer lending. You know, they have a lot of loans given to property, but they're also income-producing properties that have tenants in them. So, yeah, it was one of the companies that I have been looking into investing through. So I was impressed and thought they were doing a good job. Derek is asking, peer-to-peer are still using cavalier language to describe their products. Yeah, the FCA is definitely sending out some warnings about that. One of the biggest issues with the language is just not really explaining risk. A lot of people who are inexperienced in peer-to-peer don't really understand the risks that are involved. So I think you'll see some changes and some really policing of the way that the peer-to-peer companies are able to advertise and use that language, but it's important to understand really what the risk is. So I definitely agree with you there, Derek. So yeah, if you have any questions about peer-to-peer lending, just pop them in the chat. And please also, I'm not selling anything here, just to let you know, just hit that thumbs up button for me and subscribe if you can to my channel. It helps me out a lot. Hit the thumbs up if you like the live stream. I'm planning on doing probably one a week just to keep you updated. And if I hear anything, I'll pop it on the live stream. David says, can you say something about your two-fund system of investing, US tracker and global fund tracker? How are you handling the rebalancing aspects at the moment? Yeah, so if you read my website, you'll see that I'm a big fan of the two-fund index tracker investing method, which is the US equity tracker fund and the global bond tracker fund. So David, what I have not done yet is rebalance at all, because I don't think the markets are stable right now. I think that the markets have room to fall. I think that the market jump that you've seen in the last couple of days is because of the stimulus announcements, but the economy is still going to suffer over the next periods of weeks, and I think you're going to see the markets really drop over the next few weeks. So rebalancing for me will probably come if the S&P hits the 1800, 1700 range, which I think it might. I'd be looking to rebalance and move some of the bond fund over to the equity tracker. So when equities are low, the idea in theory is you're hedging your investments using the bond fund, which during times of economic instability, you'll see the bond funds remain relatively level. And I'm not talking about corporate bond funds. I'm talking about institutional when it comes to government bonds and stuff like that. As the ones that the global index trackers tend to be more heavy weighted towards government bonds, and those tend to stay more stable. So my bond tracker at the moment, I think, is down about 3%, which is far better than what the equity tracker is down. So the idea is if you have, say, a 60-40 split, 60% your equity tracker, 40% your bond tracker, depending on what your risk tolerance is, you can go higher or lower, that you would move some part of your investments from the global bond tracker and switch into the equities when the market drops. There is some market timing involved in that, so there's not really any science to it. A lot of guesswork. I mean, if you've looked at the markets recently, you've seen them. The Dow is at 18,000 now. It's a little bit under 21,000. So trying to time the market right now is just very, very difficult. You're never going to know when the lows are. You're never going to know when the highs are. So you just do your best, to sort of keep an eye on the news and see when the markets start to settle. Will probably be a lot of news based. When the news starts to say we're getting over this virus, I think you'll start to see the market settle down. That's when I would maybe do some bond rebalancing, but it won't be a lot. I've always kind of kept a split of anywhere between 75% equity tracker to a 25% bond split, and I probably wouldn't change it too much, maybe 70-30. And again, it depends on your age too. If you're near retirement age and you want to protect your capital, you probably want to have more weight in a bond tracker than you would in an equity tracker, because anybody who's in retirement age right now is probably looking at their retirement account and just going, what the hell is going on? And those are the people that if they need that money, they don't want to be invested heavily in the equity index tracker. If they don't need the money, if it's just extra money for them that isn't too much of a concern, then it's okay to take the risk in the equity tracker. But that's why you want to sort of keep the balance depending on what your risk tolerance is. If you have a high risk tolerance, you can go 100% equities, 90% equities, people who are younger in their 20s definitely should be very heavy weighted on the equity side, not in the bonds really much at all. But it just depends on your risk tolerance. Annabelle, you didn't miss much. My recipe for hand sanitizer and hand soap is in the chat. And also, if you look in the chat, you'll see a couple of links to some interesting websites that I found. Yes, apologies for sending the wrong link. Sometimes I do make mistakes. I usually make one mistake on each email I found, less that I need to spend more time reading through them and just making sure they're 100% accurate, but I'm always rush, trying to get things done. So ES says, do you think the peer-to-peer platforms will become more stringent in their lending criteria? Why do you think that? Yes, I mean, they're going to have to be, because they're going to get more applications now. The economy is in a mess. Businesses are going to need short-term, medium-term funding, and peer-to-peer is a great place for them to go. Mainly, they're going to have to be stringent, because if they make bad loans to companies that can't make debt payments, then they're going to have more defaults, and that'll mean that interest to investors won't get paid out, and people like you and I will be running for the exit. So there's a tough balance for them. What you saw Lendy do is make too many loans to pad their profit pockets, and ended in disaster for the company. So we have to have faith that the companies are going to make smart loans and not loosen their lending criteria just because they want to add fees and make more profit. So hopefully the peer-to-peer lending companies will do what they're supposed to do and do their due diligence and make smart loans. So that's why I think that. UK Soul says, I think you invest with Cufflink. I believe they dropped out of your recent top 5 list. So I'm still a fan of Cufflink. What I've done is adjusted my top 5 for right now. And that's because a lot of people who read my top 5 are new investors, and I don't think Cufflink is a bad place to invest. I think there's a little bit more risk involved with them now because of what's going on with the economy. Real estate property development is going to slow. Real property sales will slow, and therefore people that are building houses are going to experience more difficulties. I think that's just naturally part of what's going on now, and I believe Cufflink, will be fine. I have a phone call scheduled with them next week. I'm definitely not panicked about them. I just think the lower risk companies have moved more into my top 5 now. You've seen a couple of companies on there that weren't on there before, like Octopus Choice, which you can't actually invest in right now, and Lend Invest. So a little bit of that lower risk tier popping in, with LoanPad being in there too. So Cufflink, if it was a top 6, Cufflink would be on there. Yeah, I mean, LendingWorks dropped out. If you're wondering why LendingWorks dropped out, I just haven't seen any increase in their provision fund, which used to be 700,000 or 800,000. Now I checked yesterday; it was 75,000, and I want to see that provision fund increasing, because it's not particularly a good thing when they don't have that buffer in the provision fund. So that's why they dropped off my list. They're supposed to have several million pounds of incoming payments from borrowers that would pad that fund. I just haven't seen that fund increase. So there's another company that dropped out of my top 5 list. Again, doesn't necessarily mean they're in financial trouble, but my list sometimes changes. David said, how long would you wait before panicking with your peer-to-peer investing if the coronavirus lasts the rest of the year? David, I wish I had an answer for you. I don't think there is really much you can do with the panic side right now. I mean, even if you wanted to exit out and this virus lasts till the end of the year, I think it's more of a hang on and wait to see what happens, and just, hopefully you're diversified correctly. You don't have all your eggs into any one basket when it comes to peer-to-peer. And not only that, hopefully you have, diversified not only through peer-to-peer, but through other forms like cash and stock market, things like that. I'm not panicked. Ask me again in 2 or 3 months. We'll see. Hillary, what does too long look like? Too long would look like a year to me. So, yeah, I would say if it lasted 12 months, that would be too long. I mean, you can't have people quarantine for 12 months. It would just have such a devastating effect on the economy that I think within 6 months' time, you're going to see some kind of a vaccine against this virus, or you're going to see it just kind of run its course and just reduce. If China's telling us the truth, which is questionable, it's happening there now. You've seen very few cases. If you go to the website that I showed you earlier, which I'll put in the chat again, that will give you the numbers from today, the new cases of corona in China right now. It's 55 today, yesterday 67. So, I mean, it seems like they've really got a handle on it. You're just seeing Italy, new cases today, almost, over 9,000, Spain over 4,900, and then USA is just the place where I just knew it was going to be bad in the US. The reason is people are just not taking it seriously here. Sorry, I'm in the US right now. I should be in the UK at the moment, but travel, I'm not able to come back. So the US is, if you've seen some of the news stories, people are out on the beaches, they're too close to each other, and they're just passing the virus on. So a lot of the younger generation thinks they're immune from it. So it's just become a bit of an issue. Yes. What type of peer-to-peer do you think will be the safest for peer-to-peer investing during this time and post-coronavirus? Are there any types you think we should keep away from? There may be a couple that are sort of off of your radar. Unbolted might be one you would like to look at. Unbolted offers pawn, P-O-W-N. I always struggle with that word. Pawn, anyway, P-A-W-N loans that people are going to need short-term money, and the first thing they do to get cash is turn to silly things like payday lending, or more sensible things like I use the word sensible loosely because some of the interest rates that pawn shops charge are ridiculous, but at least they can get their money back. So they're going to pawn things like jewelry, gold, watches, and that's the type of business that Unbolted relies upon. So during times of economic uncertainty, Unbolted could be a place where you would see some stability and some growth. The lower safe is a really sort of subjective word. What I think is safe, you may not. I have some contact with peer-to-peer companies maybe that you don't have access to, but I'm comfortable with the investments that I have right now. I think anything on my top 5 is okay. If it's on my top 5, I have money in there. I don't have too much in Octopus, Choice, and Lendinvest purely because I only have so much money to invest in peer-to-peer, and I just happen to have a lot of it spread out when I started investing through those 2 companies. But I wouldn't be uncomfortable with anything on my top 5 at the moment. I haven't exited out of too much. I think I took a little bit out of LoanPack because I needed some money for other things, but still invested through them. What would I stay away from? Okay, so if I'm looking purely short-term, virus happening short-term, property is going to be difficult short-term. But, having said that, if this thing runs its course over 3 months, I don't think property is going to be that bad. Now, if I thought the virus was going to be here a year, I probably wouldn't be investing in property-backed lending as much, which I don't think it will be a year. But yeah, and I know my top 5 is only a top 4 at the moment. for a reason. I'll be updating it again. I was really kind of stuck on what to put in as my top 5 because I had a couple that were even. And so I'm going to look at that again next week and re-upload it. So, yeah. So I think again, it's really hard to say what would I stay away from because if I give you an example, LoanPad is property backed, right? But they have such a good business model and that the risk is reduced, even though it's property backed. So because the loan to values are low and LoanPad has a first position on all of the loans, even before their lending source, who also has 25% minimum of their own money in each loan. So they have skin in the game. So even though it's property backed, and I say I'd stay away from property backed, not in all cases. And so in the case of LoanPad, I'd be okay with it. So you just have to look at, what are these companies actually lending money on? Some of the property backed lending is very smart. As far as I understand, PropLend has some very sensible property backed loans. Crowd Property, Property Crowd, even though that's not really, Property Crowd's not really peer-to-peer lending. It's more coupons, bonds, stuff like that. But they have sensible lending. Blend Network has very sensible property-backed lending. So I don't know the sector I would necessarily stay away from. It's just more of the companies you got to watch out for. I'm not putting anything in the very high risk lending companies, the 12% type loans. So there's not many of them left. I still have some money through Able Rate. Not putting anything more into those high return loans. I just don't have the appetite for risk. So look at more of the companies and what type of loans they're offering rather than, these different sectors, and to say, well, consumer loans are no good or property-backed lending is no good, because you can't really make that group judgment about the different types of loans anymore. Why do I invest in a U.S. tracker as opposed to a global tracker? Equity. So, David, I've always thought that the U.S. is sort of the hub of the global economy as far as the companies that are operating from the U.S. I mean, you've got the huge tech companies, you've got the Apples, the Microsofts. It's just always been a really stable economy as far as business goes. And also what you'll see is, if you look at the FTSE's movements compared to the US, they're very similar. When the US market's down, the FTSE is also tends to be down. So I just have a lot of faith in the history of the US stock market and the S&P, and the returns of the S&P 500 have always been, if you average them out over however long it's been in existence, for 75 years or more, you've seen the returns about 11 to 12%. So all you can do is look at history. I mean, of course, there's a possibility that the U.S. market goes into recession, but I mean, history has shown that the U.S. market has bounced back through some of the worst economic declines, the Great Depression in the 1920s. You had the Wall Street meltdown, the 1980s, the 2000s, the 2008s, and every time the U.S. market has always rebounded. So there's nothing wrong with global equity trackers. I mean, sometimes they've outperformed, sometimes they underperform, but I just have always sort of bet on the U.S. markets as being the leaders of sort of the world economies, and that's why I like them. There is some exchange rate risk, but right now, because your pound is weaker against the dollar, you are going to get better value investing in a U.S. tracker. For somebody that invests over a long period of time, those things really even out. There's a good article on Vanguard's UK website about exchange rate fluctuations and what it means to, if you're buying US equity trackers, and they make the point that over the long term, if you're investing long term, which trackers are really good for long term, They really even out with the exchange rate fluctuations. So that's why I tend to favor the US tracker. So it's always done well for me personally, and the research that I've done on them. They've been historically very even and have done well. So David says he likes the LoanPad low LTVs. Yeah. When I was in London, I went to visit LoanPad's lender, Hanf, and I just got a really good understanding about their business model. What I love about LoanPad's lending source, they only have one right now, which I don't mind that. I actually like that. They have a great relationship with LoanPad, and they really care about investors' money. They have their own money invested through every single one of their loans. Hanf puts in, I believe, 25%. They have many, many millions of their own money, which they invest, so they stand behind every single loan. And they're in second position to LoanPad, which is amazing. So, I mean, LoanPad's really figured out how to reduce the risk on that peer-to-peer business model, and that's why you see LoanPad, number one, why they don't pay really high interest rates, because their risk is low and the spreads are low. So they just want to reduce for you the risk as low as possible. So that's why I like LoanPad. PropLand only has first legal charge on property, which is why I like them. Cufflink has skin in the game. I invest only in first charge with them. First charge is a great way to reduce risk. Now, yeah, first charge is really important. I went to visit, oh God, who was it? It's completely skipped my memory, but one of the companies that offers shares in properties. I went to visit them when I was in London, and they are doing second charge development loans, which in partnership with another lender. Let me just look and see who it was, because I want to give you the wrong information. Property Partner. Property Partner is doing, that is right, I believe. Property Partner. Is it Property Partner? Yeah, I think it's Property Partner. I don't like second charge loans. And yes, it is Property Partner. I've always been opposed to them. If you're looking for higher interest rates, you can take a gamble on second charge loans. But when second charge loans are paying 10%, you just got to know that the risk is high. If anything goes wrong with one of these development deals and you're in second position, chances are, if the first position loan to value is high, like 60, 70%, you may not see any return of your capital on a second charge loan. Now, worse is if the company itself that's offering the peer-to-peer or crowdfunding loans goes out of business. You've seen it with Funding Secure. I mean, if you had a second charge loan on Funding Secure on one of the loans that's in administration, you're just not going to see any of your money back. Even on some of the first charge loans, they're seeing 35 or 40% recoveries, because there was a lot of bad deals that were bad loans that were made on that platform. But I just tend to stay away from second charge lending myself. I just don't see that there's really any reason to take extra risk like that. Philip says, Octopus Choice aren't reinvesting interest and any repaid loans. Better withdraw the cash and invest again when things settle. Yeah, I would just wait, Philip, and give things a month or two to settle down. There's never anything wrong than sitting on the sidelines, because the interest is not huge that you're getting. It's better than a bank rate, but I'm sort of in a wait and see pattern with regards to pulling money out if I need to. I do pull some of my interest out when it gets repaid, but that's just because I want to reinvest in some other peer-to-peer companies that I haven't tried yet. So Octopus, I would say just wait and see. That they're really good at communication and sending out updates, so I think they'll let you know if it's going to be a long-term situation. I've got the IFIS, ES says, I've got the independent IFIS, the IC, you know what I'm trying to say, the Cufflink. You're not able to choose only first charge. You have to take what you get. Yeah, you do. You are going to have a mix of both first and second charges. I don't have ISAs with Cufflink, so that is one of the downsides of having an ISA in that, where they're picking things out for you. You have to take what they can get, but it will all even out because they don't have a ton of second charge loans, so it's not like the whole portfolio is in second charges. So I wouldn't worry too much about it. Yes. Hi Dale, how are you? Thank you, by the way, to everybody who's on the stream today. I think I sent out the wrong link on the email. Yeah, sometimes mistakes happen, but I was fielding a lot of emails from people, so I was really busy and didn't think to check the link. But thank you. Please hit the thumbs up. Give me 2 if you can. It helps me out with the YouTube algorithm. And you can go ahead and sit back here. So let's a couple more questions. Dale, I'm new to trackers, so probably a dumb question. No, it's never a dumb question, Dale. Trackers to YPI receive. I presume you're asking me if trackers receive dividend payments from the stocks too. Yes, they absolutely do. Oh, okay. Thanks, yes. Yeah, trackers. So what happens, trackers have 2 different types of funds. They have accumulation, and accumulation is ACC, usually at the end of the tracker. It'll be, and then there'll be INC, which is income. And both forms do receive dividend payments from all of the stocks that are held within the tracker funds. What happens with the ACC is it gets, all of the dividends get reinvested. It's an accumulation. So anything that you get paid out as a dividend gets reinvested in the form of more of a tracker. So you get more tracker shares. Income, when you have an income version of it, you get paid out the dividend that the index tracker pays. It's usually relatively small, fluctuates. Some of the bond funds pay a little bit more than the equity funds. But yeah, you do get dividends. Apologies for the links, yes. So let's talk about a couple of other things on, if you have any other peer-to-peer lending questions. Again, I haven't seen anything that's causing me to panic yet, but I'm looking at things on a very short-term basis right now to see what happens with the virus. And we're just going to go month to month with it. But even though I think a lot of companies were positioned to be able to handle an economic downturn, I mean, they had to be. They just had to be, because it was going to happen at some point where there'd be a recession. So some of the companies are going to be well positioned. And what we're going to see is the real strong companies are going to come out of this and thrive forward, become better peer-to-peer lending companies. And the weak ones will probably not make it through. So hopefully we are not invested in the weak ones. That's the key, is to be invested into the strong ones, and just to preserve capital right now. That's the important thing. So I just wanted to talk about stock market a little bit. I'd be very careful. I'm getting a lot of emails about people asking which stocks to pick. One of my friends had a bright idea to buy shares in a ventilator company, which seems like a good idea, right? But think about this. If you invest in a ventilator company and they produce too many ventilators and they can't sell them because all of a sudden the need for ventilators dries up, you will probably have a problem with that company in the future. People are saying, well, what about airline stocks? The volatility on airline stocks is risky. The stocks are going to continue to move up and down, and the market timing is next to impossible. Wanted to address, why I'm really very hateful on managed funds, managed unit trusts, managed mutual funds. You've seen the big problem is about these funds. The UK property funds are struggling right now. You've got Threadneedle, Aviva, Legal & General have all suspended trading on their funds because what's happening, those are property-backed funds and the funds can't sell property quickly. So when everybody's running for the exits, they experience the same problems as the peer-to-peer lending companies do. There's just nobody willing to take those shares over, so they can't, investors can't exit. So they have to suspend the funds. M&G suspended a £2.3 billion fund recently because they're unable to liquidate properties to pay investors. And then you've got some problems with investment trusts too now. Honeycomb, Pollen Street is looking for someone to take over their assets. So it really goes to show you that these managed investment funds can have the same issues that peer-to-peer lending is struggling with. These are things that you don't really think about when the economy is good, and why I've always said managed funds are just, I just don't believe in them at all. I really don't. They can have problems just like any other investment can. But what I like about index trackers is my index tracker is not in the hands of anybody other than the people that are buying shares to match the market, to match the indexes. There's no trading involved. Managed funds have higher fees. There's also fees that you don't see. So for instance, Fundsmith is a really popular fund in the UK, and their fee is 1% per year, right? The problem is in the background, there's other fees that are happening that you don't see as an investor. One of the biggest ones is the capital gains tax that funds like Fundsmith have to pay. They're constantly trading trading shares. And when they trade and make a profit, they have to pay capital gains tax. So that comes out of the fund, which is a fee that you pay as an investor. So you've got that churning, and the tax are not tax efficient at all. And then they've got these high salaries that they have to pay the fund managers, which can be anywhere from millions to hundreds of millions of pounds a year. Well, that comes out of the fund that you have to pay as a investor. So there's some calculations. I was recently looking at Fundsmith because everybody says to me, "Oh, Fundsmith's a great fund to buy." Sort of the darling fund of the UK, but over 5 years, if you have £10,000 invested in Fundsmith, it's probably going to cost you about £530 of upfront fees. That's upfront because you have those back-end costs that you don't see that's going to reduce your returns. And also, Fundsmith has about 65% US stocks. So if you pull up a graph on the Morningstar and let's say you compare Fundsmith with the Vanguard US equity fund, you're going to see a really close mirroring of I can't do it, but it'll be like that. There'll be some times where they'll crisscross each other. You see a lot of mirroring because Fundsmith has a lot of US stocks, and they're buying the same things that are in the index trackers. They're just charging you money to manage it, and they're charging you for the name. So if you invested 10 grand in Fundsmith over 5 years, you're going to likely pay about £530 versus 10,000 invested in my favorite darling US equity Vanguard index tracker. You're going to pay £66. So, those are huge savings, and you start multiplying that by 10. If you have 100 grand, you're looking at fees of over 5,300 in the Fundsmith versus £660 in Vanguard. So you really need to pay attention to those. And the returns in the managed funds are not even that. They can be less for sure. But I looked at Fundsmith and see over the last 6 months, Fundsmith is down 7.5% versus the index tracker down 3.2%. Over the last year, they're almost identical. Actually, the index tracker is up 10.8% versus Fundsmith 10.3%. And then you'll see some fluctuations over 5 years where the Fundsmith has done a little bit better, 16% versus 12.5%. But I think over the very long term, you're going to see the index tracker really just equal or do better than the fundsmith because you don't have the tax inefficiencies and you don't have the high fees. And also, these fund managers get it wrong. Look at Neil Woodford. He's got it completely wrong. And yeah, so that's why I say go for the index tracker. Just my opinion. Of course, you should do your own research. I buy all of my funds through Vanguard directly. In the UK, it's about, on the US index tracker, you're paying about 0.25% total. That includes the platform fee. It's 0.15% for the platform fee and 0.1% for the fund fee. Some of the funds have different fees. The bond fund is a little bit higher, and it does have a bit of an entry cost. But also with the bond fund, people say, well, bond funds really don't return anything, but Vanguard's past performance on the bond fund last year, 18 through 19, the global bond fund was up about 6.6%. So there are years where bond fund will do well and give you some capital protection, which the equity fund won't. 2018 to 19, the US index tracker was up about 25.5%. So it's performed really well. So yes, I'm a hater on the managed funds. I always have been. I just don't think people need them. But do your own research, please, and just sort of do the comparisons on the charts and see how close they are with the index tracker funds. I don't do the FTSE tracker funds. I think they're too small. You don't have enough companies in the FTSE to have real diversification. So I tend to want the bigger funds that have thousands of shares in them that give you better diversification. Okay, let me give you answers to a couple more questions, and then I'm going to end the stream. Assets capital. Yes, you're welcome for the explanation. Let's see. Yes, I will do a regular stream once a week over the next few months. Absolutely. I plan on doing them a Thursday or Friday. Let me know if any day is better for you, Thursday or Friday. If you like the evening times, if you want daytime streams, I can do it, earlier on. I just figured everybody's probably stuck at home right now, so evening time streams are good, but I'm planning Thursday or Friday at the moment. You're welcome for the explanation, Dale, on the trackers, no problem. Do I have any thoughts on the assets situation? So Assets Capital has put a freeze on the exiting from them. Now you can obviously withdraw cash if you have money in your cash account that's not set to reinvest in the QAA, which is the quick access fund. But if you have money in the QAA, you cannot exit right now. Do you think, so Dale's asked me if I think they've handled the liquidity situation better or worse than other peer-to-peer companies. I think they've handled it quickly, which is important. They're just suffering from the lack of demand from people wanting to buy the loans that people want to sell. So I think they've handled it just fine. I don't think there is anything more that they really could have done. If they don't have money to pay people out because there's no liquidity, which peer-to-peer never offers guarantee liquidity. We've all been really blessed with liquidity over the last few years because it's been there in most cases, but it was never a guarantee. So you're just seeing what happens when liquidity dries up and why, in some cases you really have to look at peer-to-peer loans as a longer term situation if liquidity does dry up. But I think Assets has handled it just fine. Hi, Agam. Is it time to take profits from iShares, Barclays 20+ year Treasury Bond Index ETF? Well, Let me have a look, because it's not one that I invest in. Listen, taking profits is never a bad thing. Yeah, it's had a massive uptake, 21.7% in 1 year, which is very high. Let me look at the portfolio and see what's in it. United States Treasury. Is it time to take profits? It depends. I mean, what are you going to do with the money, right? My stock market investments have always been long term, so I just don't sell unless I need the cash. 20% in 1 year is great. So if you need the money for something, yeah, I mean, take the profit. Why not? Question is, what are you gonna put the money into? If you're gonna reinvest it in something, sure. If you need the money, sure, take the profit. If you have to pay tax in it, if it's if it's not in an ISA, so think about that. It's never wrong to take profits in the stock market if you need the cash. Annabelle, how can I persuade my mom, 85, away from a lifetime with managed funds with a big company to DIY trackers like Vanguard? How can you persuade her? Does it really matter to a mother who's 85 years old if she's on sort of a more, I hate to say it, short-term investment outlook? So I've always thought it best not to really persuade people to do anything they don't want to do. I just present information to them and I'll let them make their own decisions, because the problem with persuading other people is if you make a mistake or something bad happens, they're going to look back at you and point the fingers. I've had this situation with family members that I've been really careful about what I've suggested. One thing that I would do, Annabelle, which I think is a really good idea, is have her invest a little bit into a tracker like Vanguard. So she's got, I don't know, 10,000 pounds invested through her big fund. Have her put 1,000 pounds in and let her watch it for a year and see how it does. It's just, you're in unusual times right now, so performance might be different for her. But I think her managed funds, performance-wise, are probably going to not be doing well on the equity side. So have her put a little bit in to a index tracker and let her sit on it for a while and see what she thinks about it. But I don't believe in persuading people to do things. Just give them the information. She could read the John Bogle little book of common sense investing, which you can get on Amazon, and let her read that, see if it makes sense to her, and then let her make her own decision. So assets are delivering, withdrawals are just slower than usual. I got a payment today. So David, was that a withdrawal of cash that was sitting in your cash account, or was that an exit from a fund withdrawal? I'd be interested to know. You're welcome, Megan. MP says the Fed has committed to this massive package of economic stimulus, and they will buy billions and billions of bonds. Therefore, I accept the U.S. bond funds will go up. Yeah, well, that depends on whether people are exiting, because a lot of people are in panic sell mode. It's what happens when the markets go down. You get your average investors who sell at the wrong time. They sell when the markets are going down rather than up. And they buy when the markets are going up versus down, which is completely backwards, but that's what happens. Financial advisors, they get a lot of pressure from their clients when markets are bad. People panic and they'll sometimes tell their advisors to sell, even though the advisor will say not to do that. So, but I would take a guess and think the bond funds will do okay, but I think you might see some volatility in the short term because you are going to have a lot of people exiting. But again, I only buy index trackers. Also, I get a lot of questions about why not ETFs. If you look at my website, I just posted an article, which I'll give you a link to if you want to read it. it is my coronavirus investment strategy. And I do touch upon the reason why I don't buy ETFs, which are exchange traded funds, and why I buy index trackers. Now, one of them is index trackers are valued once a day, so you can't trade them. Vanguard in the US puts trading timelines on their trackers. So if you sell a tracker, sometimes you cannot buy that same tracker again for a period of 30 days. The reason they do that is they don't want the volatility of the pricing on the index trackers, so they want them to stay relatively level. ETFs are traded on the stock market like stocks and shares are. So Peter, ETF is an exchange traded fund. And they're valued a little bit differently to index trackers. They actually are quite difficult to value. And the companies that offer ETFs also have third-party companies that help them value ETFs. And you can see some real volatility in ETFs that you won't see in the index trackers. So that's the reason why I buy index trackers. Also emotionally, because I know I can't trade index trackers, it makes me not want to trade in and out of them and try to buy and sell on market time like I can with an ETF. So I stay away from the ETFs. ETF is a great backup if you don't want to buy index trackers. Some of the index trackers have minimums. In the UK, they're £500 for the Vanguard minimums, but in the US, some of them are 3,000. So sometimes people don't have 3,000 to put in, so they'll buy an ETF because they can just buy one share, and so it's better for them in that respect. But if you don't have a need to want to trade in and out, which I don't think is a great idea because we usually get the timing wrong, then I would definitely suggest the tracker versus the ETF. 7-Eleven Honvet asked, do you see the US leading the world out of this economic meltdown? I think the US tends to be the barometer of economic health. If the US economy is good, it tends to lead towards economic health in other countries. But, countries have their own economic issues. I think the one thing about the coronavirus is it sort of puts everybody on a level playing field, right? Every country is experiencing the same problem. And what you can see is you can look at past histories of what previous countries have experienced with the virus and see how they're leading out of it. So China, if China is being truthful, is leading out of it. And we can look at that as a barometer of what will happen in other countries if they follow suit on how they contain it. But I do see the US as leading the world out of the economic meltdown, because if the US gets a handle on their economy and starts to stabilize the stock market, what happens is other stock markets in other countries tend to stabilize. You tend to see the FTSE really following the US when it comes to the stock market downturns. So if we can get the US economy more stabilized, it will definitely be helpful on world economies for sure. Annabelle, you are very welcome. So, yep, that's about everything that I had today to talk to you about. Again, if you have any other questions, spot them in the chat. Please hit the thumbs up and the subscribe button. Most importantly, please be careful out there. This is a time for health, right? Money is not the be-all and end-all in this world. If your health is gone, your money doesn't mean anything. So wash your hands, make your own soap if you need it. Don't hoard. Stay out of the contact of people and stay away from elderly people. If you're elderly, stay away from people in general. And just be healthy and be safe. We care about each other, and check on your neighbors, phone your neighbors and your family or your friends if they need anything. The elderly right now, you can drop groceries on their doorstep if they need something from the supermarket. And it's a time for really watching out for each other. And we're all in this together. I'm quarantined at home right now. And I think it's going to last a while. I see myself being inside for 30 to 60 days and not doing it just for myself, but I'm not that old, believe it or not, but I'm doing it for the other people out there that can really get sick from this virus, to protect them. So I hope you guys are healthy and safe, and thank you for all the support. The website is continuing to grow, and I'm in the middle of doing some really big updates on the reviews. Obviously, things are changed right now, what I would do normally, but it's a lot of information to change, so thank you for your patience. And I will likely be on again next Thursday or Friday, probably Thursday, to do another live stream at 7:30 UK time. And God bless everybody, and have a great weekend. Take care.